Technical analysis is the study of charts in order to predict future price movements. At the core of a binary options trading strategy is the ability to predict the direction of asset price movements. So a successful binary options strategy requires an understanding of how to interpret asset charts. Hi, my name is Reese Shapiro, and I am your binary options trading coach. During my 10+ years trading options for a major bank, I've dealt with many different charting methods. I had charts of multiple assets in front of me at all times, and each one had various indicators, moving averages, and different levels to help me predict the direction that my assets would go in the future. Charts can help you with these types of predictions if you know what to look for. Now, you may have seen on CNBC or in other financial news some technical terms like moving average, support, resistance. Traders pay attention to technical indicators such as these in order to help them decide when to enter and exit trades. With binary options, the trading process is quite simple. We only need to pick an entry price and direction. The exit strategy is already known up front, because either we'll make our full payout if we're right, or we'll lose our investment if we're wrong. So it's really just that entry decision that we need to focus on. And charting can really help you decide when to enter a trade and what direction you should place that trade. In this video, we'll learn the basic anatomy of charts. We'll go through some real-life examples of charts and how you can use them to predict price momentum in your assets. This is the 4th lesson in our series. If you've missed any of our earlier lessons, please go back and watch them again. Even if you think you already know the material, I bet there'll be something in there that you'll learn that you didn't already know. And if this is your first time watching this video, I usually suggest that my students watch each video at least twice. The first time through, you might miss something that you'll catch the second time or even the third time. So watch the video, take some time to go over your notes, and then watch it again. Now, speaking of your notes, you'll want to grab a pen and paper before we start. Go ahead and put me on pause, go grab a pen and paper, and come back. You'll want to have a pen and paper handy so you can jot down some notes or questions that you may have on the material. We're going to go over a lot of new information today, and I find writing down notes and questions helps me learn new concepts more quickly and more thoroughly. You're getting a lot of information through this video series, and most of it is probably new to you. So you want to make sure to be patient with yourself and with the learning process. Take the time you need to build a knowledge base in trading. Everyone learns at their own pace, and it's better to take your time to learn to trade well, rather than rushing ahead without all the skills and knowledge that you need to succeed. So be patient with yourself. Now let's jump right in. The premise of technical analysis is that price and volume are the only pieces of information necessary to analyze trading assets. You don't need fundamental information because all of that information is processed by the market, and the price and volume represent the output. Technical analysis is the study of price and volume and how they evolve over time in order to predict future price movements. For binary options trading, it's very important that we learn to predict future movements. And in particular, we can simplify the analysis a lot because we only need to predict the direction. Which direction is the asset going in? We don't need to be so worried about how much it will move in that direction or when we'll close our trade or what we'll do if we're wrong initially. All we need to focus on is finding a time at which we can accurately predict the direction that an asset's about to go, so that we can place our successful binary options trades. Now, at the core of a technical analysis is a candlestick chart, and this that I'm showing you right here is a candlestick chart. We use candlestick charts instead of a line graph because they give us a ton of information about asset price movements. So if you had a line graph, it would just look like this, and you wouldn't get all this information that's embedded in the candlestick chart. Once you learn how to read and understand these candlestick charts, you will be able to gain a lot of insight about the price momentum in your asset. So this is a candlestick chart on the currency pair euro versus dollar. Each of these little things is known as a candle, so I just circled a green candle. And each candle, which is also known as a bar, indicates the direction, up or down, of the market during that period. In this chart, each bar represents 5 minutes of trading, and the entire chart, from beginning to end, totally represents about a day's worth of trading. Now, there are other candlestick charts where one bar might represent a full day of trading, and the chart will show you perhaps an entire year of trading. So multiple bars, each one representing a day. The whole chart will show you a year. And those types of charts would be more useful for a longer term trading strategy. Maybe you've got a strategy that will put you in a trade for a day, a few days, even a few weeks. For high frequency trading and very short term binary options, you can look at 1 minute bars where the chart will show you only a part of a day's trading. But I find for regular digital binary options, this type of 5 minute chart tends to be the most useful. If you're trading turbo binary options, which can be much shorter time frames, the 1 minute bar chart might be more helpful. But for now, let's stick to the 5 minute chart. And you can quickly look at a chart to see the overall direction and some of the intermediate trends based only on the color of the chart. So you can see by looking at this chart, to me it looks mostly green, and in particular starting around here, around 10 o'clock, the overall direction of the chart was kind of up. My brain kind of filters for red and green, so I see a lot more green in that part of the chart. But there were some red sections within here, and your eye can quickly tell you these are slight corrections because of the color of the chart. Now let's drill down and look at each bar. Each bar is basically just a neat little way to show the open, close, high, and low of the asset during that period. So here we've got two colors, white and black. Some charts will use white and black, other charts will use red and green. Usually a white candle indicates a bullish candle, and that means that the asset closed higher than it opened. The black candle means that the asset opened higher than the close. Usually a green candle will be like a white candle, and a red candle will be like a black candle. So the body is the thick part of the candle, where the color is. The bottom of the body, right here, will indicate the open in the case of a white candle, or the close in the case of a black candle. And similarly, the top of the candle will indicate the close in the case of a white candle, or the open in the case of a black candle. So you can see that that body indicates the difference between the open and the close in all cases. Now these upper parts, these lines above and below the candle, those are called the upper shadow and the lower shadow. Sometimes they're called wicks. And this indicates the high and the low of the asset during that period. So the top of the upper wick is the high of that asset during that period. And the bottom of the lower wick, or the lower shadow, is the low of that asset during the period. And that's the same whether it's a white candle or a black candle. Some candles have big wicks, meaning that there was a lot of movement in the asset, and that would be outside of what the open and the close would indicate. Other candles have really long bodies with very short wicks, which basically indicates that most of the information about the trading is wrapped up between the open and the close. There wasn't a lot of trading outside of that level. So you can see that there's a lot of information that's wrapped up in these little candles, because you can see not only the open and the close, but also the high and the low. But the one thing that candles don't tell you is the actual path or trajectory of the asset during that period. So for example, let's take this white candle as an example. Let me give you two different scenarios for how the asset could have traded, and both of them are possible using this white candle. So choice A would be that first the asset opened here at this open level, then traded down to the low, then traded up to the high, then down to the close. So that would be like situation 1. And that's possible with this type of candle. Situation 2 would be, and I guess I can draw it over here, would be that the asset traded first opened here, then traded up to the high, then down to the low, then back up to the close. So this would be like situation 1 for the white candle, and this would be situation 2. And both of these situations are totally possible for this white candle right here. Either one of those is a possibility. So it tells you a lot of information, but it doesn't tell you whether we traded more like situation 1 or more like situation 2. Now let's go back to our 5-minute candlestick chart. So on this chart, I want to point out a few candles that really demonstrate some of these ideas. So let's zoom in on this candle here. You can see that it's a red candle, which means that the close was lower than the open. Here we are zoomed in on that one candle. Now, let's go back to what we learned about candles. The red candle means that the close was lower than the open. So this level right here has to be the open, and this level right here has to be the close. Now, if we look at the shadows, this level up here has to be the high, pardon my handwriting here, and this level right here has to be the low. Now, looking at this candle in the context of the chart, we can see that the candle before it was a green candle. So in this candle before it, the close must have been higher than the open. Here, this level was the open in the prior period, and here, this level is the close. And you can see this makes sense and it flows that in this green period, the asset closed at this level, and then the next tick, the open for the period that we're talking about, this red candle, was right here. So it closed and then it opened. And then moving on to the next candle, which is also a red candle, we have the close in our period that we're talking about here. And then in this next red candle, the asset opened here at that same level, proceeded to trade down. So let's go back to our bigger chart, because I want to point out some more interesting candles. In this green candle, there's no wick. It's a green candle, so the top of the body is the high, and the bottom of the body is the open. The fact that there's no wick means that the close was the highest level that asset traded during that period, and the open was the lowest level. So most likely what happened during this period, although we don't know for sure, but most likely what happened is that the asset opened at the low, traded higher during the entire period, and closed at the high. Similarly, in this red candle, it also has no wick. In a red candle, the top of the body represents the open, and the bottom of the body represents the close. So in this red candle, the asset opened at the high, traded down, and closed at the low. Although again, we don't know for sure what the path looked like, but that's probably the most likely outcome. So in these candles, the open and the close are the high and the low. And that body gives you all the information that you need about trading. Now let's look at a third candle. Let's look at these little candles in here, and they're both kind of similar. They're both red candles. They both have small little bodies and relatively longer wicks. And what that means is that the open and the close were very close to each other, but that the asset traded in more of a range than what's indicated by the high and the low. So you really need to understand the entire candle to understand the trading action that happened during that period. And this is where we talk about controlling the price action. Whoever's controlling the price action is going to determine the momentum of your asset. And the momentum is exactly where we're trying to get. If buyers are dominating the price action, our asset is going to go higher. And if sellers are dominating the price action, our asset is going to go lower. So let's see how that applies to our charts now. So let's take a look at this long red candle on the left here. The red color means that the close was lower than the open. And the size of the body, it has a relatively big body. So that means that the asset went down significantly during the period. There's no upper wick, so that means the open was the highest price that the asset traded during that 5-minute session. And the lower wick is really small, meaning that the close was pretty close to the low for that 5-minute session. So in this candle, I would say that sellers dominated that price action. The buyers, the bulls, were nowhere to be found. Let's look at another candle now. Let's look at this green candle. Here the body is relatively long again, and the wicks are relatively small. But this time the candle is green. So that means the asset opened at the low, traded higher, and closed near the high for that session. In this candle, the bulls, or the buyers, were dominating the price action, and the sellers were nowhere to be found. Now you might remember the concept of momentum from physics. In case you don't, it's pretty simple. Objects in motion tend to stay in motion. That means if an asset has positive momentum, it should continue to go higher. So you see how there was positive momentum and it continued to go higher. And similarly, if an asset has negative momentum, it should continue to go lower. And the momentum will continue until some other force acts upon that asset. And usually that type of a change is driven by the opposite force. If we go back to this chart, positive momentum will end when sellers come in and start acting on that asset to force it to come back down. And negative momentum will end when buyers come in to try to push that asset back up. So with charting, we're going to try to look for who's currently driving the asset, and then where do we think that opposite force might start to come into play. Now, single candles are very useful, but the real significance comes in when you're looking at the candle chart that contains multiple candles. Looking at the whole chart, you can see more than just the closing price and the open during that period. You can see whether the buyers or sellers were driving the asset price action over a longer period of time. And you can start to see prices at which opposing forces might act on your asset. So if we look at this whole chart, the general trend, I would say, is kind of in an upward direction, right? At the beginning of the day, the market was, you could say sideways, you could say slightly down, right? Depending on your viewpoint. But that looks like it was kind of, it started coming in down, and then around just before 10 o'clock, around 9:30, 10 o'clock, you could see that upward trend kind of started, right? And so if you were looking to enter a trade, you would be wondering at what point and how do you know when that price trend reversal is going to happen? And how do we identify these situations? Well, we need the concept of support and resistance. So support is a level at which buyers are lurking or hiding. Maybe people have limit orders to buy at that level. And what happens is, as the asset's trading in towards the support, you'll typically see a bounce off the support. And bounce off a support is a bullish signal, a sign that momentum is about to change. Similarly, if the asset were to fall through support, that's a bearish signal that maybe those buyers that were hiding there before are now gone. So we'll have to look down here for the next support level. We'll have to try to figure out where that is, and the asset might fall all the way to that next support level. Now, resistance is like the mirror image of support, maybe where sellers are hiding with limit orders to sell. So as an asset's coming in, trading like this, when it hits a resistance level, you'd expect it to bounce off of that resistance level. And just like support, it's possible that an asset can break through resistance, which would be a bullish signal. Because once it breaks through that resistance, it means these sellers are gone at this level. So you need to look for the next higher level for resistance. And the asset might get all the way to that next level. So support and resistance levels can be really helpful in your analysis of charts. So we have to figure out how to locate support and resistance on a chart. The other thing that I should mention is that support kind of becomes resistance. So let's say an asset is trading along like this, and we know that this is a resistance level. Maybe it's bounced off the resistance level, but at some point it breaks through resistance. Now, when the asset's trading up here, we'd expect that resistance level would become support, where it could bounce off that level going forward. Okay? So let's see how this works using our 5-minute chart on euro versus dollar. So let's look at this pair of candles right here. The first candle in the pair is a red candle with a relatively long wick below the body. So this means that the sellers dominated the first part of the period. You can see that The asset opened, maybe it traded a little higher at some point during that period, but for the most part it traded lower. And it traded all the way down to the low. But then at some point the buyers are starting to show up at the table, because the buyers were able to drive that asset back up to close higher than the low. So it looks like the sellers might have won the battle in that period, but the buyers weren't absent. They were definitely there. And if we move to the next candle is actually green. And that means that the buyers were able to win that battle in that period. Buyers were able to take over control from the sellers and push the asset just a little bit higher, but higher, to close above the open. And the other thing I want to point out in this candle, because I think it's important here, is this blue level. And this blue level is what I would call a support or resistance level. And how did I draw that in? Well, I looked at other areas in the chart that look significant. So in the beginning of the chart, it looks like the asset had traded up to a high of about this level. So it looks like maybe it bounced off of a resistance there. Now here, coming in, it was able to slightly break through that resistance level. And here, when it broke through that resistance level, it became sort of a bullish breakthrough. So now it's coming back down. We talked about resistance as support, and here it looks like even though it traded a little bit below that level, for the most part it kind of bounced off that level and the trajectory was higher. So when we start to see the pair look like it's beginning to bounce off of that level in the first candle, which was a bearish candle, but it bounced off that level, and then in that second candle where the buyers were able to win out, to me it looks like that bounce is kind of firming up. And that's a very bullish signal. So at that point, I would have gone over to my binary options trading screen. I would have looked at call options on this asset, and I would have placed a call option saying that this asset is going to go higher. And sure enough, I would have been right if I had picked, just about any expiration during the rest of that day. So we've talked about a lot of things on this EUR-USD chart. Let's take it over to another currency pair, another chart. This is a chart of US dollar versus the yen. And again, it's a 5-minute candle over a 1-day period. So in this chart, the initial trend coming in looks quite bearish with lots of long red candles. And at that point, you should be asking yourself, is this bearish trend going to continue? Going to continue down here like this, or is it going to reverse? And that's the question. We're looking for that point. At what level do we think it's going to reverse? Now, at this point, we can't see the support and resistance, because if we were here at 8:45 in the morning, we wouldn't know what's going to happen in the future, right? You only know what happened in the past. But it's possible that there's a support level here that the asset's bouncing off of, and it might be, slightly higher, but somewhere in here, there's probably a support level. Because you can see that as we came down towards that level, here these long wicks hit the level, and then you see this little candle here, little body, long wicks, where the buyers were actually able to win out. And sure enough, after that bullish signal, after that bounce was confirmed, the buyers were able to win out, and it traded up to here. I also want to point out to you this candle right here. So it looks like the broader trend was down, right? We had a couple of small downturns here and here, and now we're in this kind of trend, this downward trend. But we had this little bit of an upshot right here. And so the question, again, is whether this little bit of an upshot is going to continue and the asset's going to trade higher. At what point is that trend going to reverse? So during this candle, it's a red candle, so it means that the sellers won out. But the high is much higher than the close. This has a very long wick. So it looks like what happened was, and again, we don't know for sure, but it looks like what happened is in the beginning of this period, this bullish trend continued. The asset opened here, traded up to the high, but then the sellers came in. Wait a minute, we're going to control the action, and we're going to push this asset back down. And so actually the sellers were able to win out during that candle and push the asset back down. And this is a pretty bearish sign. And sure enough, if I draw in that resistance level, you can see here, this level is a pretty important resistance level. You can see it right here. You can see it right here. There are a couple of points in recent history where that resistance was tested, and sure enough, as we got to that level during this candle, the asset bounced off that resistance level. So at that point, after this candle, I would find that a good point to enter a binary put option. So by now you should have a pretty good understanding of the basic anatomy of a candlestick chart. You should know how to use them to determine price action, and we've gone over some simple examples. I suggest that you find a source for price charts. You can use freestockcharts.com or investing.com. Sites like these have candlestick charts that you can look at for free on just about any asset. So try to bring up a few assets and start analyzing them to see if you can identify trends, support, resistance levels. Again, the idea is to get a sense of whether the buyers or the sellers are dominating the price action, and then invest based on that sense, based on the direction that you think that price momentum is going. And the great thing about binary options is that you don't have to worry about the magnitude of the move. You just need to get that direction right. So once you're comfortable predicting price action, you'll have a huge advantage in your binary options trading. Now, if you have any questions, you can send them to us at any time. We'll be glad to help you fine-tune your trading and make sure you succeed. Before I end this video, I'm going to go over some of the questions that I get from a lot of my students so that you can all benefit from the answers. So a lot of the questions that I get about charting go something like this. And let me go back up to a chart. So a lot of the questions might go something like, why did you put this support line here? Why didn't you put it up here? Or why didn't you even put it just right here? Just a little bit higher. You might have that same question about, the other chart that we looked at. And the answer is that there's a little bit of an art to charting, because support and resistance are more like areas than exact numbers. Buyers and sellers are groups that are made up of individuals. It's not as simple as just two people in a battle. So each individual might have a slightly different decision process as to where to put in limit orders. A lot of times support and resistance will be at exact round numbers. So for example, 102.5 might be a good spot for a support level or a resistance level because people might enter limit orders there. And you can see that might, but you never know exactly where those limit orders are because again, they're not in one exact location. They're usually areas of support and resistance. So you might choose to put your support or resistance line at a slightly different place than where I put mine. The general idea is that you're able to identify when the asset is near one of those areas so that you can look for that bounce or that breakthrough. Now, many students write to me telling me that sometimes they'll be wrong in their predictions. They followed my teachings and the asset didn't always behave as I described. And this might happen. Sometimes there's more at work than what we described so far. So you might see an asset tick a penny above where you drew your resistance, and you might think this is a bullish signal, only to have the asset actually bounce down off of that resistance level. So again, these are regions of support and resistance, not exact pinpointed levels. So you might want to look for a solid breakout or two candles in a row that seem to confirm the momentum. What defines a solid breakout will depend on the asset, will depend on the momentum on the asset, and it might just depend on the situation. Sometimes it looks like something's going to go one way and then the situation changes and it goes the other way. Nothing's ever 100%, but the goal in charting is to give you some insight as to which direction the asset is likely to go in the future. You're never going to get a 100% guarantee. So that's it for this lesson. If this is your first time through, I suggest you watch it at least one more time, just to make sure you have a handle on everything that we talked about today. If you missed any of our earlier videos, please go back and watch them at least once. In our next video, we're going to go through the different types of binary options and how to trade each one profitably. And this next lesson will help you tremendously in your trading. For now, I'm Reese Shapiro, your binary options trading coach, and I'll see you next time.